Yields spiked. Auctions tailed. Dealers stepped back from the market. The headlines blamed selling pressure or foreign buyers disappearing. They were wrong. This wasn't about demand. This was about funding. The repo market just signaled stress, and the entire Treasury curve felt it. In the next 17 minutes, you will understand the funding loop that most analysts ignore. You will see how repo stress forces dealers to shrink their balance sheets. You will learn why auction tails appear when funding tightens. You will discover the chain reaction that moves from overnight lending rates all the way to your mortgage rate. And you will understand why this mechanism matters more than any Fed speech or inflation report. By the end, you'll be able to read auction data like a professional bond trader and spot funding stress before it hits the headlines. Let's start with the basics. The repo market is the plumbing of the financial system. Repo stands for repurchase agreement. It's an overnight loan collateralized by securities. A bank needs cash for one night. They give you a treasury bond as collateral. You give them cash. Tomorrow they buy back the bond and pay you a tiny interest rate. That rate is the repo rate. This happens trillions of dollars every single day. It's invisible. It's automatic. It keeps everything liquid. Think of repo as the oil in the engine. Without it, nothing moves. Banks use it to manage daily cash needs. Money market funds use it to earn returns. Hedge funds use it to leverage positions. The entire financial system runs on the assumption that repo will always be there, cheap and abundant. When that assumption breaks, everything downstream breaks with it. Now, let's talk about dealers. Primary dealers are banks authorized to trade directly with the Federal Reserve and participate in treasury auctions. Their job is to make markets. When the Treasury issues new bonds, dealers bid at the auction, they buy the bonds, then they sell those bonds to pension funds, foreign governments, and asset managers. They earn the spread. But here's the key. Dealers don't use their own cash to buy treasuries. They use borrowed cash. They fund their inventory through the repo market. They borrow short-term to hold bonds that mature long-term. This works when repo funding is cheap and abundant, but when repo funding tightens, the entire machine seizes. A dealer might earn 2 basis points on a $100 million transaction. That's $20,000. Not bad for a few hours of work. But to earn that, they need to fund that $100 million cheaply. If repo costs eat up 1.5 basis points, their profit margin drops to 0.5 basis points. The trade is barely worth it. Scale that across billions in daily volume, and you see the problem. Small changes in funding costs destroy the entire business model. Treasury auctions happen on a regular schedule. The government needs to borrow. They announce an auction. Dealers and investors submit bids. The Treasury accepts bids starting from the lowest yield until the entire amount is sold. The highest yield accepted is called the stop-out rate. The difference between the stop-out and the when-issued market rate beforehand is called the tail. A small tail is normal. A large tail is a warning sign. It means demand was weak or uncertain. It means someone hesitated. The tail is the market's way of saying we're not comfortable at the expected price. The funding loop begins with repo stress. Repo rates can tighten for several reasons. Regulatory balance sheet constraints hit at quarter end. Banks pull back from lending overnight. Or collateral becomes scarce because everyone wants treasuries at once. Or settlement systems get clogged. Whatever the cause, the symptom is the same. The repo rate spikes. It might jump from 50 basis points to 150 basis points overnight. For a dealer holding billions in inventory, this is a crisis. Let's do the math on why this matters. A dealer holds $10 billion in treasury inventory. They finance this through repo at 50 basis points annually. That costs them $5 million a year. Manageable. Now, repo rates triple to 150 basis points. The cost jumps to $15 million. That's $10 million in additional funding costs with zero additional revenue. The dealer is bleeding money just to hold inventory. Their response is immediate. Shrink the balance sheet. Stop accumulating bonds. Bid less aggressively at auctions. But the pain doesn't stop there. Higher repo rates also mean higher haircuts. A haircut is the discount applied to collateral. Normally, you can borrow $98 for every $100 of treasury collateral. That's a 2% haircut. When stress hits, lenders get nervous. They increase the haircut to 5%. Now you can only borrow $95 for that same $100 bond. You need more collateral to borrow the same amount of cash. Your leverage capacity shrinks. Your ability to participate in auctions diminishes. The dealer who could have bought $5 billion in treasuries can now only afford $3 billion. The market just lost $2 billion in absorption capacity. Balance sheet capacity is the second constraint. Dealers operate under leverage ratio rules. They can only hold a certain amount of assets relative to their capital. Repo funding itself consumes balance sheet space under certain accounting rules. When repo rates spike, it often signals that balance sheet is expensive across the system. Even if a dealer wants to buy treasuries, they might hit their regulatory limit. They can't expand. This constraint is invisible to the public, but binding for the dealer. The leverage ratio doesn't care whether you're holding safe treasuries or risky corporate bonds. It treats all assets the same. A dealer has a leverage ratio cap of 20 to 1. They have $100 billion in equity. They can hold $2 trillion in assets. That sounds like a lot. But they're already holding $1.9 trillion across various books. They only have $100 billion in capacity left. An auction comes. The Treasury wants to issue $80 billion. The dealer looks at their capacity and realizes they can only take down $20 billion without breaching their limit. They bid accordingly. The other $60 billion has to be absorbed by other market participants. But if all dealers are similarly constrained, who's left? Now watch what happens at the auction. Normally dealers show up with aggressive bids. They know they can fund the inventory cheaply and flip it quickly. But when funding is tight, their calculus changes. An auction is announced. Dealers look at the repo market. Rates are elevated. Balance sheet is expensive. They bid, but they bid cautiously. This creates the tail. The when-issued market might show demand at a certain yield, but the actual auction clears at a higher yield because dealers weren't willing to take down as much supply at the expected price. The tail is the gap. When-issued yield is 3.5%. The auction stops out at 3.58%. That 8 basis point tail is a funding signature. It's the market telling you that dealers didn't have the capacity or willingness to absorb supply smoothly. Here's what no one explains. The tail isn't about fundamentals. It's not about inflation expectations or fiscal deficits or foreign buying. Those things matter in the long run. But the tail is a microstructure event. It's a plumbing issue. It's a signal that the intermediation chain is stressed. The dealers who are supposed to buffer volatility can't buffer anymore, so volatility breaks through. The tail measurement itself is revealing. A tail under 1 basis point is considered clean. The auction went smoothly. A tail between 1 and 3 basis points suggests mild caution. A tail above 5 basis points is a red flag. It means demand was materially weaker than expected, and if you see multiple consecutive auctions tailing wide, you're watching a funding crisis unfold in real time. The dealers are waving a white flag. They're saying, we can't do this anymore. The mechanism tightens further through collateral loops. When dealers pull back, fewer bonds get distributed into the market. This can make treasuries harder to borrow in the securities lending market. Scarcity in the lending market feeds back into repo. Collateral gets expensive. Repo rates stay elevated. The loop feeds itself. Dealers stay cautious. Auctions keep tailing. Yields stay elevated. The system is stuck in a doom loop where funding stress begets more funding stress. Now let's trace the cascade. It starts with repo stress. That stress forces dealers to reduce treasury holdings. Dealers pull back from auctions or bid less aggressively. Auctions tail. Yields rise to clear the market. Higher yields mean higher borrowing costs for everyone downstream. First domino, mortgage rates. Mortgage rates are priced off longer-term treasury yields plus a spread. If 10-year treasury yields jump 20 basis points because of auction tails, mortgage rates jump 30 basis points because of the pass-through. A homeowner looking to refinance sees their rate, quote, go from 6.5% to 6.8%. The savings disappear. They cancel the refinance. Multiply this across millions of households. Refinancing activity collapses. Consumers have less disposable income. Spending slows. The mortgage market is particularly vulnerable because it's heavily dependent on rate-sensitive refinancing activity. When rates are low, homeowners refinance aggressively. This generates fee income for banks, employment for loan officers, and disposable income for households who lower monthly payments. When auction tails push yields higher, this entire ecosystem freezes. Loan officers get laid off. Title companies see volume drop. Appraisers sit idle. The ripple from a funding event in the treasury market cascades into Main Street employment. But here's the twist. The yield move isn't because the economy changed. It's because the funding loop broke. The fundamentals are the same. Growth is the same. Inflation is the same. But the plumbing seized, so rates moved. This is why monetary policy transmission can feel erratic. The Fed might hold rates steady, but if repo stress hits, yields can spike anyway. The Fed doesn't directly control long-term rates. The market does. And the market is constrained by dealer capacity. This creates a credibility problem for central banks. They announce forward guidance. They say rates will stay low. But then funding stress hits, auctions tail, and yields spike anyway. The public sees the Fed as either dishonest or impotent. But the reality is that the Fed doesn't control the plumbing. They control the policy rate. The plumbing determines whether that policy rate actually transmits through the system efficiently. Second domino, corporate credit. Corporations issue bonds to finance operations. Those bonds are priced as a spread over treasuries. When treasury yields jump because of auction tails, corporate bond yields jump even more. A company planned to issue debt at 5%. Now after the auction tail, the rate is 5.4%. They delay the issuance, or they shrink the offering. Less corporate debt issuance means less capital for expansion, fewer jobs, slower investment. The real economy feels the funding stress, even though most CEOs have never heard the word repo. The corporate credit market is less liquid than treasuries, So when treasuries get stressed, corporate bonds get hammered. Investment-grade corporate bonds might trade at a spread of 100 basis points over treasuries normally. When auction tails widen and treasury yields jump, that spread can blow out to 150 basis points. Not because corporate credit quality changed, but because the entire market is repricing for lower liquidity. Companies that were planning to refinance maturing debt find themselves locked out. They have to tap credit lines. Bank balance sheets get squeezed. Lending standards tighten. The spiral continues. Third domino, risk assets. When funding is tight, leverage becomes expensive across all markets. Hedge funds use repo to finance positions in stocks, bonds, and derivatives. If repo rates spike, their cost of carry rises. They have to deleverage. They sell positions. A quantitative fund holds a leveraged position in equities financed through repo. Repo costs double. The position is no longer profitable. They unwind. Selling pressure hits stocks. Volatility spikes. Retail investors see red on their screens and panic. But the root cause was repo, not earnings or economic data. The correlation breakdown is the scariest part. Traditionally, stocks and bonds were negatively correlated. Stocks down, bonds up. This relationship breaks when funding stress hits. Stocks sell off because hedge funds deleverage. Bonds sell off because dealers can't absorb supply. Both assets fall together. Diversification fails. Portfolio protection fails. Investors are left naked to the storm. And the storm started in the overnight funding market that nobody watches. Let's pause and acknowledge the psychology. Most market participants don't think about repo. They see auction results. They see yields move. They invent narratives. Foreign sellers, deficit concerns, inflation fears. These narratives aren't wrong, but they're incomplete. The proximate cause is often funding. The dealers couldn't intermediate. The auction tailed. Yields adjusted. Everything else is downstream. Fourth domino, municipal debt. State and local governments borrow through municipal bond markets. Those markets rely on dealer intermediation. When dealers pull back from treasuries because of funding stress, they also pull back from munis. Muni auctions start to struggle. Yields rise. A city planned to issue bonds to fund a water infrastructure project. The auction tails badly. The borrowing cost is now too high. They cancel the project. Construction jobs disappear. The local economy weakens. All because repo rates spiked 2 weeks earlier and dealers couldn't hold inventory. Fifth domino, bank balance sheets. Banks hold treasuries as high-quality liquid assets. When treasury yields spike because of auction tails, the market value of existing holdings drops. Banks see unrealized losses. If those losses are large enough, it constrains their lending capacity. A regional bank holds a portfolio of treasuries yielding 3%. Yields jump to 3.5%. The portfolio is now marked down. The bank has less equity cushion. They tighten lending standards. Small businesses can't get loans. This is the interest rate risk channel, but it's triggered by the funding loop. The accounting rules amplify the pain. Banks that classify securities as available for sale have to mark them to market through other comprehensive income. This hits their regulatory capital ratios immediately. Even though the loss is unrealized and will reverse if they hold to maturity, the regulatory impact is instant. Banks close to their minimum capital requirements have to take action fast. They stop lending. They raise deposit rates to attract funding. They sell securities at a loss to raise capital. The cascade doesn't stop at financial markets. It reaches households. Higher mortgage rates mean fewer home sales. Lower home sales mean fewer appliances sold, less furniture bought, fewer moving services hired. The velocity of money slows, economic activity contracts, unemployment edges up. And if you trace it all back, the starting point was repo stress forcing dealers to step back from auctions. Now, here's the really insidious part. This mechanism is invisible to policymakers in real time. The Fed sees yields rise, they see auction tails, but they might interpret it as demand destruction or inflation concerns. They might not realize it's a funding issue. If they misdiagnose the problem, they prescribe the wrong medicine. The Fed sees yields spiking and thinks the market is worried about deficits, so they talk tough about fiscal discipline. But the real issue is repo. The market doesn't need a speech. It needs balance sheet capacity. The misdiagnosis prolongs the stress. What does this mean for the person trying to buy a house or refinance a loan? It means the interest rate you see is not just about the Fed or inflation. It's about whether dealers can fund their inventory. It's about whether the repo market is functioning smoothly. You might have perfect credit and stable income, but if the funding loop is broken, your rate quote goes up anyway. The system's plumbing affects your wallet directly and immediately. For small businesses, this mechanism is deadly. A small manufacturer wants to borrow to buy new equipment. They go to their bank. The bank says rates have gone up. The manufacturer asks why. The banker says market conditions. But the real reason is that treasury yields spiked because of auction tails, which happened because dealers couldn't fund inventory, and which happened because repo was tight. The small business owner has no idea. They just know the loan is now unaffordable. They delay the investment, growth stalls, jobs that would have been created disappear. The funding stress in New York kills a factory expansion in Ohio. For retirees living on fixed income, auction tails create a perverse outcome. When yields spike, the price of existing bonds drops. A retiree holding a bond portfolio sees their account value decline. They feel poorer. They cut spending. This is the wealth effect in reverse, triggered not by economic weakness, but by funding stress. The mechanisms of finance bleed into the psychology of households. The retiree doesn't understand why their supposedly safe bond portfolio just lost value. They blame the market. They blame politicians. But the real culprit was a liquidity event in the repo market. The second consequence is the fragility signal. When auctions tail because of funding stress, it exposes how dependent the system is on dealer intermediation. Dealers are the shock absorbers. When they can't absorb, the shock transmits directly to end users. This fragility isn't about solvency, it's about liquidity. The system has enough capital, but not enough funding flexibility. And liquidity crises can become solvency crises if they last long enough. Educational only, not financial advice. The third consequence is policy blindness. If the Fed and Treasury don't recognize that auction tails are funding signals, they might respond with the wrong tools. They might raise rates to cool demand when the real issue is dealer capacity. Or they might expand bond issuance when dealers can't absorb more. The mismatch between diagnosis and treatment extends the crisis. Markets stay dysfunctional longer than necessary. The Fed might even tighten policy thinking inflation is the problem when dealers simply can't fund inventory. This isn't a bond story, it's a funding story. The repo market determines dealer capacity. Dealer capacity determines auction outcomes. Auction outcomes determine yields. Yields determine everything downstream. The loop is invisible until it breaks. And when it breaks, the consequences ripple through mortgages, credit, and the real economy with brutal efficiency. Next time, we investigate the collateral squeeze. When treasuries become scarce to borrow, repo rates spike even higher. We'll map the special collateral phenomenon and why some bonds trade at negative repo rates. We'll explain the fails chain and why settlement breaks multiply stress. We'll show you why collateral scarcity is the next stage of the funding crisis. Watch for these signals. Repo rates diverging from policy rates, auction tail patterns widening, primary dealer treasury holdings declining, collateral scarcity in specific securities, especially on the run issues, and settlement fails data climbing. The funding loop isn't finished, it's accelerating, and the next break could be bigger than the last.